So today we gonna discuss our third block, and in this third block we need to discuss about the companies. One is holding company, and which companies are subsidiary company, and how we can maintain their financial statements in a consolidated way. Because if we are talking about the holding company and the subsidiary company, uh, a company who is having a more share in a particular company, that company will be known as the holding company, and the company which is having the less number of shares, that particular company is known as the subsidiary company, and the accounts in the end will be made simultaneously and in a consolidated way also. So how we can basically know that which company is a wholly owned subsidiary company, partly owned subsidiary company, and what companies are the holding companies actually, and how we prepare the consolidated financial statements, their advantages and their disadvantages. So the procedure of preparing the financial statements also we need to know about. So, if I am just talking about the objectives of this particular unit, so this unit explains us about the difference between partly owned company and the wholly owned subsidiary companies. Then they also describe the conditions under which the companies are not required to prepare the consolidated financial statements. Then they also tell us about the advantages of consolidated financial statements, describe the disadvantages of consolidated financial statements, and also explain the procedure for preparing the consolidated financial statement with all the adjustments. So basically in the unit 9 we already discussed about the holding company and the subsidiary company and the types of holding company, and how we can prepare the final accounts of holding company without any adjustments. So basically in this unit we learn about wholly owned and partly owned subsidiary companies, and there are some exemptions also available under which the companies are not required to prepare consolidated financial statement. So we learn the procedure of preparing final accounts of holding companies with all adjustments. So first of all we need to know about the difference between the wholly owned subsidiary company and the partly owned subsidiary company. So, in the case of wholly owned subsidiary company, a particular company whose all shares are owned by the holding company is known as wholly owned subsidiary company. Means a particular company whose all the shares are holding by the are held by the holding company. In the case of partly owned subsidiary company, when the majority of shares of the subsidiary are owned by the holding company, it is known as partly owned subsidiary company. Means some shares are with the holding company and some are with the subsidiary company in the case of partly owned subsidiary company. Then if we just talk about the situation, so in the case of wholly owned subsidiary company, 100% voting rights are vested by the holding company, because all the shares are with the holding company, so all the rights of voting are also belongs to wholly owned subsidiary company. Then under this, in the case of partly owned subsidiary company, more than 50% but less than 100% of voting rights are vested by the holding company. Next one is, there is no case of minority interest, because all the percentage of shares are with the wholly owned subsidiary company. So just because of the fact that the whole of the share is owned by the holding company, so there will be no minority interest, and we don't need to calculate the minority interest. Next one is, the actually case arises about the minority interest, in which always less than 50% of share, so we need to calculate the minority interest also. Now, there are some exemptions from preparation of consolidated financial statement. So, when there are some certain conditions in which the companies are not required to maintain or the preparation of the consolidated financial statement. So, as per Companies Account Amendment Rule 2016, there are as follows. First one is, it is a wholly owned subsidiary or is a partially owned subsidiary, that is B Limited is a partly owned subsidiary of A of the another company, and all its other members, including those not otherwise entitled to vote, and intimate in writing, for which the proof of delivery of such intimation is available with the company, that is with B Limited. Do not object to the company not presenting consolidated financial statement. Next one is securities of subsidiary company, that is B Limited, are not listed and are not in the process of listing on any stock exchange, whether in India or outside India. Next one is, it is also ultimate, that is A Limited or any intermediate holding company files consolidated financial statements with the registrar. So, to put more clarification, we have some graphical presentation in which there is an example. They told us, according to the section 3 companies, that is A Limited, B Limited, and C Limited, there are three companies. So, and they are, and there is a holding in each other. In the case of first one, A Limited holds 80% equity in B Limited, B Limited holds 80% equity in C Limited, and C Limited is a subsidiary of B Limited. So, like this, we have a graphical representation like A Limited, this particular thing, holding company of B Limited. B Limited, it is a subsidiary of A Limited and holding of C Limited, and in the case of C Limited, subsidiary of B Limited. So next one is how we can have the consolidated financial statements. So in the case of consolidated financial statements, these are the statements prepared by the holding company for the group of enterprise which is controlled and owned by it. These financial statements present the financial information about the holding company and its subsidiary as a separate entities. So these statement highlights these following points. First one is economic resources owned by the group of enterprises. Second one is the obligation of the group. Third one is the result achieved by the group with its resources. Then the enterprise that present the consolidated financial statements, that should present these statements strictly according to the accounting standard 21 consolidated financial statements, and these are issued by the Council of the Institute of Chartered Accountant of India, which came into effect in respect of the accounting period commencing on or after 1st 4 2001. So according to this standard, the holding company which present consolidated financial statement should present these statements in addition to the separate financial statements. So now, what are the benefits of consolidated financial statement? First one is unified source of document. If we are talking about the consolidated financial statement, it is a uniform source of document which we can present the ultimate picture to the user about the financial statement, and both the companies maintain their separate account, or both the companies are actually separate entities, so they also make their separate accounts, but in the end they consolidate their accounts and make a single balance sheet and make a single profit and loss account which represent for the group as a whole through consolidation of the account. Second one is ascertainment of return on investment in subsidiary. So return on investment is measured on the basis of the total share of the holding company in the revenue profits of the subsidiary, and this information is provided by the consolidated balance sheet also. Third one is measurement of liquidity. In the case of consolidated financial statement, it helps in the measurement of the liquidity of the holding company as well as the enterprises under its control. Then fourth one is measurement of efficiency. The consolidated financial statements help in the measurement of the efficiency of the holding company as a whole. So the statement help the investor to evaluate the efficiency of the company and take their decisions accordingly. Next one is ascertainment of the intrinsic value of the share. So the consolidated financial statement of the holding company are necessary to ascertain the intrinsic value of the share of the company. Next one is the disadvantages of the consolidated financial statement. We have two disadvantages. First one is misleading information. So if the activities of the subsidiary company do not match with the other company of the group, it mislead the investor in taking the decision. Second one is concealment of important information. When the financial statement of the company in the group are aggregated, sometimes the important information is concealed with the investors. Next one is, what is the procedure of preparing consolidated financial statement with adjustment? So the main objective of consolidated financial statement is to show the information of holding company and subsidiary company under a consolidated form as a single entity. We have some steps involved in the formation of consolidated financial statement, so we will discuss these steps here. First one is the cost to the present of its investment in each subsidiary and the parent portion of equity of each subsidiary at the date on which investment in each subsidiary is made should be eliminated. Any kind of excess of the cost to the parent of its investment in a subsidiary over the parent portion of activity or equity of the subsidiary at the date on which investment in the subsidiary is made, and it should be described as a goodwill, and goodwill is known as the asset in the consolidated financial statement. Third one is when the cost of the parent of its investment is in a subsidiary is less than the parent portion of equity of the subsidiary at the date on which investment in the subsidiary is made, the difference should be treated as a capital reserve in the consolidated financial statement. Next D is minority interest in the net income of consolidated subsidiary for the reporting period should be identified and adjusted against the income of the group in order to arrive at the net income attributable to the owners of the parent. Our next point is minority interest is the net asset of consolidated subsidiary that should be identified first, and then it present in the consolidated balance sheet separately from liabilities and the equity of the parent shareholder. So minority interest in the asset side that consist these following items. First one is the amount of equity attributable to minorities at the date on which the investment in a subsidiary is made, and second one is the minority share of movement in equity since the date the parent subsidiary relationship came in existence. Next one is dividend from subsidiary company out of pre-acquisition profit. Pre-acquisition profit, the profit which is before when the company becomes subsidiary or holding, before the profit a particular company is having, that will be known as the pre-acquisition profit. So during the first time when the holding company receive any kind of dividend out of pre-acquisition from its subsidiary company, here are some journal entries which we need to record. First one is bank account debit to shares in subsidiary company, being dividend received from subsidiary company out of pre-acquisition required. Second one is dividend received from subsidiary company account debit to P&L account, the transfer of dividend from subsidiary company to profit and loss account. Next one is treatment of profit on revaluation account, revaluation of asset. So basically, in the case of revaluation, when each and every year our asset revalued, so we need to analyze them. If our asset is appreciated, we need to add the value, and if our asset is depreciated or deducted, then we need to deduct it from that value. So profit on revaluation will be added to the equity share capital reserve P&L account while calculating the amount due for calculation of both goodwill capital reserve and for the calculation of the minority interest. Here we have a balance sheet of R Limited and M Limited as on 31st March 2021. We have two sides, one is liability and one is asset, and we have both the companies R Limited, Limited, and about their share capital reserve, asset, investment, preliminary profit and loss, creditor, expenses. So on 31st March 2021, the fixed asset of M Limited were revalued at rupees 5,50,000. You need to prepare the consolidated balance sheet as on 31st March 2021. So according to the solution, calculation of goodwill capital reserve, first of all, the amount which we paid, that will be rupees 2,60,000. It is given in the question. Here it is investment in 70% shares of M Limited, that is 2,60,000. So calculation of goodwill capital reserve, that will be 2,60,000. The amount which we need to pay, then we deduct the amount which is due. That one is 3,50,000, 60,000, 50,000, and from this we deduct 70,000, and the from the whole we will calculate it for 70% because the investment which we have done is 70%. So it will, the total will be 3,15,000. So basically the amount which we paid, it's 2,60,000, and the amount which is due is 3,15,000. So we are in negative. So here we have a 55,000 of capital reserve, because the deduction or the loss which we bear, which will be uh, uh, deducted from the capital reserve account. So in the case of minority interest, which we calculated as given below, that is equity share capital plus reserve plus P&L account plus profit on revaluation, then we deduct the fictitious asset multiplied by the remaining percentage. So according to this, we have the minority interest of rupees 1,35,000. Now we will prepare the consolidated balance sheet as on 31st March 2021. So in the share, in the liability side, share capital of rupees 10 each, 4 lakh, minority interest 1,35,000, reserves 1 lakh, profit and loss account 1 lakh, Capital reserve 55,000. Then we have a creditor R and M. R is for 2 lakh, M is for 1 lakh. The total is 3 lakh. Then we have a asset side. In the asset side, R limited invested 5 lakh 40,000 and M limited 5 lakh 50,000. So the total is 10 lakh 90,000. Next one is pre-accusation and post-accusation profit. So there are various illustration which we already discussed, and we assume that the share of the subsidiary company which were acquired on the date of balance sheet. So all the profits of the subsidiary given in the balance sheet were treated as pre-profit or the capital profits. However, in the actual practice, the date of acquisition of shares and the date of balance sheet are different. In such cases, the subsidiary company reserve and profits must be divided into pre-profits, that one is capital profit, and post-profit, that will be known as the revenue profit. So on the basis of date of acquisition of the shares, we will decide which one is pre-acquisition profit, we consider it as a capital profit, and which one is post-acquisition profit, that will be considered as a revenue profit. So the holding company share in pre-acquisition profit is treated as capital profit, which I already told you, and is used for the purpose of calculation of goodwill or capital reserve. Next one is holding company share in post-acquisition profit is treated as revenue profit, and it is added to the P&L account of the holding company. Next one is how we can calculate pre-acquisition profit of subsidiary company or a capital profit. So in the case of pre-acquisition profit, we have opening balance of P&L account, then we add opening balance of general reserve, and we deduct the preliminary expenses. Next one is calculation of post-acquisition profit or revenue profit. In the case of post-acquisition profit, closing profit and loss account add closing general reserve. Then we deduct preliminary expenses and we deduct pre-acquisition profit. Next one is calculation of goodwill, capital reserve in case of pre-acquisition and post-acquisition profit. So, in the case of goodwill or capital reserve, the amount which we have paid, that is the amount of investment, and we deduct amount due from it. Next one is amount due. How we can calculate the amount due is equal to equity share capital. Then we add pre-acquisition profit. Then we multiplied acquisition percentage age. Next one is calculation of minority interest. Minority interest is equal to equity share capital plus pre-acquisition profit plus post-acquisition profits multiplied by remaining percentage. Next one is the following is the balance sheet of R Limited, M Limited as on 31st March 2021. So in the case of liability and asset, we have all the information, and we have some added information, that will be the share of M Limited were acquired on 1st April 2020, on which the date the general reserve and P&L account was rupees 30,000, 20,000 respectively. Then we have the preliminary expenses, which are then in the case of preliminary expenses were not written off during the year ending 31st March 2021, then we need to prepare the consolidated balance sheet. So in the case of this solution, calculation of pre-acquisition profit will be, first of all, we take opening profit and loss account, that will be 20,000 given in question. Then we have a opening general reserve 30,000. Then we deduct the preliminary expenses from it 10,000. So the total pre-acquisition profit we have 40,000. That means 20 plus 30 is equal to 50. Then we deduct 10. So we have 40,000. Next one is how we calculate the post-acquisition profit. So in the case of post-acquisition profit, closing P&L account, first we will take 60,000, then closing general reserve account 1 lakh, then we deduct preliminary expenses 10,000, We deduct pre-acquisition profit 40,000. Then we have post-acquisition profit in the end, that will be 1,10,000. Then we have a we need to calculate the goodwill or capital reserve. So first of all, we take the amount which we paid, that will be 2,60,000. Then we deduct the amount which is due. That one is equity share capital added pre-acquisition profit multiplied by acquisition percentage. So acquisition percentage here is 70% acquired. So we add the value, that will be 3 lakh plus 40,000. Then we multiplied it for the 70%. So we get the amount of rupees 2,38,000. And the we now we are in a positive balance, so it will be known as the goodwill and not the capital reserve. Next one is minority interest. In the case of minority interest, how we will calculate? First, we will take the equity share capital, then we add pre-acquisition profit, then we add post-acquisition profit and multiplied remaining percentage. So in the case of minority interest, we have 3 lakh plus 40,000 plus 1 lakh 10,000. Then we multiplied. That will be known as 30% is equal to 1 lakh 35,000. Here we have the consolidated balance sheet as on 31st March 2021. So we have the liability side, that will be known as share capital of rupees 10 each, 4 lakh. Then we have minority interest 1 lakh 35,000. Then we have reserve 1 lakh. PNL account 1 lakh. Then we add 1 lakh multiplied by 70%, 77,000. We have creditors are 2 lakh M 1 lakh. In the case of assets, sundry assets, we have R limited 5 lakh 40,000, M limited 5 lakh 50,000. So the total will be 10 lakh 90,000. Then we have goodwill is equal to 22,000. So the total will be 11 lakh 12,000. Now we need to discuss about the share of subsidiary company which is acquired during the year. So sometimes the holding company acquire the shares of the subsidiary company during the financial year. For example, if the subsidiary company prepare its financial statements on 31st March 2021 and the holding company acquires its share on 1st July 2020, then the profit from 1st April 2020 to 1st July 2020 will be considered as a part of pre-acquisition profit, and the profit on 1st July 2020 to 31st March 2021 will be considered as the post profits. So in this case, the current year profits are divided according to the pre-period and the post period. Now, for this treatment, first step is to determine the pre-period and post-period. Our second step is pre-P&L appropriation account and calculate the current year profits. Third step is divide the current year profit into pre-period and post-period. Fourth one is add the current year profit to the pre-acquisition profit, and the current year post profit will be considered as the post profit. Step 5 is post profit multiplied by acquisition percentage, that will be equal to holding company share in post profit. This holding company share in post profit will be added to P&L account of holding company in consolidated balance sheet. So here we have an illustration. We will discuss this. We have a investment of 70% shares of M Limited, and we have reserve, current liability, each and everything. Then we have some additional information that the M Limited were acquired on 1st July 2020, and on 1st April 2020 the general reserve and PNL account was 40,000 and 1 lakh respectively. Then we have preliminary expenses which were written off during the year, that will be 31st March 21. Prepare a consolidated balance sheet as on 31st March 21. So we have a solution. First step to determine the pre-period and post-period. So pre-period will be 1st April 2020 to 1st July 2020 is equal to 3 months, and the post-period is 1st July 2020 to 31st March 2021 is equal to 9 months. Second step is to prepare the PNL appropriation account. In the case of PNL appropriation account, for the year ended 31st March 21, we have particulars to transfer to general reserve, that will be 1 lakh minus 40,000 is equal to 60,000. Then we, first of all, we have the opening balance, that will be 1 lakh, and we have a current year profits, that will be the balancing figure, sorry, and we have a closing stock of rupees 2 lakh. So we add 2 lakh plus 60,000, and we deduct 1 lakh, that will be the opening balance, and we get the current year profit of rupees 1 lakh 60,000. So the current year profit for pre-period will be for 3 months, that will cost 40,000, and for the post period, that will be for 9 months, is equal to 1,20,000. So how we can calculate the pre-profit? First of all, we take the opening P&L 1 lakh, general reserve opening 40,000. Then we have a current year profit for pre-period, that will be 40,000. Then we deduct preliminary expenses 20,000. Then we have the pre-acquisition profits, that will be 1,60,000. Now we need to calculate the post profits. So post acquisition profit will be 1,20,000. We need to calculate the goodwill and capital reserve. The amount which we paid is 4 lakh. Then we deduct the amount due, that will be the equity share capital and pre-acquisition profit, multiplied by acquisition percentage, which we have 3 lakh plus 1 lakh 60,000, multiplied by 70,000, 70%, sorry, that will be 3 lakh 22,000, and we have the goodwill 78,000. Next one is minority interest is equal to equity share capital. We need to add pre-acquisition profit and post-acquisition profit, and we multiplied the remaining percentage. So we get the amount, that will be 1,74,000. So now we need to prepare the consolidated balance sheet as on 31st March 2021. First of all, we discuss the liability side. That will, first one is share capital of 10 each, 5 lakh. Minority interest 1,74,000. Then we have reserves 2 lakh. Then we have P&L account 3 lakh, in which we need to add the 70% of 1,20,000, 84,000. Then we have creditors R and M. Then we have fixed asset R and N separately. We add it, then the value will be 10 lakh. Then we have goodwill of rupees 78,000. Then we have current assets, that is R limited, M limited, that will be 2 lakh and 2 lakh 80,000 is equal to 4 lakh 80,000. Next one is adjustment of unrealized profit included in stock. So the goods which is sold by one in the group to the another company in the group at the price more than the cost price, and some part of the goods remain in the stock as unsold, and it is the rule that the profit on such unsold goods should not be included in the consolidated balance sheet. So this profit is thus deducted from the stock and the consolidated profit. So we have a treatment for it, that will be deduct the profit on unsold goods from the stock in consolidated balance sheet, and then we need to deduct the profit on unsold goods from the consolidated profit in the consolidated balance sheet. So we have an illustration and we have additional information. First step is our same. We need to calculate the pre-acquisition, post-acquisition profit. Then in the step 2, we need to know about the P&L appropriation account. And here we have a current year profit of rupees 50,000. Then in this case, we calculate the calculation of pre-acquisition profit, that will, we have 2,12,500. Then we calculate post profit, post acquisition profit, and that in that case we have goodwill of rupees 15,625. Then we calculate minority interest, and the minority interest will be 1,37,500. And in this way we will make our balance sheet as per the calculation. And you can see that there is an unrealized profit on both the side, which we deduct from the P&L account, that will be 10,000 of multiplied by 50% of the total amount. Here are some important values or important keywords which you need to know about the holding company or subsidiary company. So this is our unit for the subsidiary company. So now our next unit is valuation of goodwill. We already discussed about the holding company, subsidiary company, and in those cases we calculate the minority interest, capital reserve, and goodwill also. So we need to know how we can calculate the goodwill and how we can analyze the valuation of goodwill. We have different kind of formulas while we are calculating the goodwill, or we are actually showing the goodwill in the balance sheet in the asset side. Goodwill has its own value in the terms of money also. So in this unit we need to discuss about the objectives of the valuation of goodwill, introduction of the valuation of goodwill, meaning of goodwill, characteristics of goodwill, nature of goodwill, what factors affect the value of goodwill, need for the valuation of goodwill. Then we have different methods of valuation of goodwills like average profit method, weighted average profit method, super profit method, capitalization method, annuity method, purchase method. Then we have our objectives. What objectives? First of all, we need to understand the meaning of goodwill. Then we need to know the characteristics of goodwill. Then we need to discuss the nature of goodwill. Then we need to identify the factors which affect the value of goodwill. Then we need to discuss the need of the valuation of goodwill and need to explain the methods of valuation of goodwill. In the case of introduction, we already discussed about the holding company, subsidiary company, wholly owned subsidiary, partly owned subsidiary, and the regulation which is applicable in case of preparation of consolidated financial statement, which we have also learned the procedure of preparing consolidated financial statements without adjustment and with adjustment. So we learn about the concept of goodwill, its definition, characteristics, nature, factors affecting the value of goodwill, need for the valuation of goodwill, and finally various methods of valuation of goodwill. So in the case of meaning of goodwill, first of all, there are different definitions given by the authors. First of all, goodwill is the value of reputation of a particular firm in respect of the profit which is expected in the future over and above the normal profit earned by the similar firm in the industry. Goodwill also represents the firm's brand name, loyal customer base, reputation for high quality of products, due to which firm earns more profits above the normal profit. So the excess of profit Excess of profit over the normal profit is also known as super profit. Goodwill which exists when the firm earns super profit, and any firm which is earning only normal profit or incurring losses has no goodwill. So goodwill consists of the advantage a business has in connection with its customers, employees, and outside parties with whom it has to contact. Goodwill has been defined by various prominent authors, and some of the definitions which are as follows. First one is given by the Lord Lindley. He said that the term goodwill is generally used to denote benefit arising from the connection and the reputation. Next one is given by Kohler, that the goodwill is the current value of expected future income in excess of the normal return on investment in net tangible asset. Because tangible assets are those assets which we can touch and we can feel, but intangible asset which we cannot be able to see or touch, that will be known as tangible assets, sorry, intangible asset, and the goodwill is known as intangible asset and not tangible asset. Here we have some characteristics of goodwill. Goodwill is an intangible asset. First of all, it is associated with the purchase of one company by another. Specifically, Specifically, goodwill is the portion for the purchase price that is higher than the sum of the net fair value of all the assets purchased in the acquisition and the liabilities assumed in the process. Goodwill has many characteristics. First one is, I already told you that it is intangible asset, because we are not able to touch and see. So that will be known as intangible asset. Like patent, trademarks, this thing. The question of depreciation does not arise on it, as it does not differ wear and tear like the other asset, because it is intangible. That's why it does not consist the any kind of wear and tear, that so depreciation, we never calculate depreciation on goodwill. Next one is, its value tends to fluctuate. So its value can be fluctuated. Goodwill cannot have the exact cost, so the value tends to fluctuate from time to time. This is due to internal and external factors which ultimately affect the fortune of the company. Third one is valuable at the time of sale of business. So the goodwill which is valued and sold with the sale of entire business, and it cannot be sold in part. The exception of this feature is the admission and retirement of the partner. At the time of retirement, the retiring partner gives up his share to the remaining partner. So the remaining partner contribute the retiring partner in the gaining ratio. And on the other hand, at the time of admission, the new partner acquire the right of profits from the existing partner. So the new partner contributes them in their sacrificing ratio. Next one is difficulty in placing value of goodwill. So it is difficult to place the value of goodwill because its value fluctuates from time to time due to changing circumstances. Next one is no objective valuation. There is no object on the valuation of goodwill, as the valuation of goodwill is done in the subjective manner and differs from estimator to estimator. And the value of goodwill is also based on the subjective judgment of the valuer. Next one is arising of goodwill. Goodwill either arises when on business is purchased by the other business, where purchase consideration is higher the actual value of net asset acquired, or the goodwill is generated by the business over a period of time due to some favorable factors like efficient management, favorable location, etc. Next one is nature of goodwill. Goodwill is nothing but the reputation of a partnership firm. It is computed on the basis of expected profit in excess of normal profit. It also denotes the firm's capacity to earn a greater profit in the future based on its track record. For examples, or they give us some points. First one is goodwill is an intangible fixed asset. It is intangible because it has no physical existence. It cannot be seen or touched. Second one is it has a definite value depending on the profitability of the business enterprise. Third one is it cannot be separated from the business. Fourth one is it helps in earning more profits and attract more customers. Fifth one is it can be purchased or sold only when the business is purchased or sold in full or in part. Next one is factors affecting the value of goodwill. So the value of goodwill depends upon various factors. First one is location of the business. If the firm is located in the centralized place where there is more traffic, high sales, that particular firm earns more goodwill. So therefore, if the business is located at the prominent place, it will attract more customers and will generate more goodwill. Second one is management. If the business has good and efficient management, it helps the business to earn more profit and goodwill. So the business with efficient and experienced management will generate more goodwill. Third one is business longevity. The business with higher longevity or the older business is known by more customers and therefore will have more goodwill. As with time, business can earn more reputation with the number of customers also goes on increasing. The fourth one is nature of product. The business which deals in the daily use products will have stable profits and demand, so will have more goodwill in comparison to those business which deal in the fancy products. Fifth one is risk. If the risk involved in the business is more, then it will have less goodwill, and on the other hand, if the risk involved is less, firm will have more goodwill. Next one is competition. If in the near future there are chances of increase in the competition of the firm, it will reduce the goodwill of the business. Next one is profit trend. If the profit of the firm are reducing from the past years, that is the profit are showing the declining trend, then the goodwill of the firm will also reduce and vice versa. Eighth one is license. If the firm has the import license, then definitely its goodwill will increase because it can take the advantages of their license, which the other firms without license cannot avail. Next one is requirement of capital. The capital requirement of the business also affects its goodwill. If the two firms earn same rate of return, then the business will, or with lesser capital, will enjoy more goodwill. Now, the point is need for the valuation of goodwill. That means why we need to calculate the goodwill. So, goodwill arises when the company acquires another business. So, the amount of goodwill is the cost of purchase the business. Then we deduct the fair market value of the tangible asset, then intangible asset and the liabilities obtained in the purchase. There are various situations in which the need for the valuation of goodwill arises, like difference in the profit sharing profit. संस्कृति कितना रहता है तो मैंने बोला अभी 6 वीडियोस और रहते हैं So the amount of goodwill is the cost of purchase of business. Then we deduct the fair market value of the tangible asset. So the tangible asset and the liabilities which is obtained in the business purchase. There are various situations in which the need for the valuation of goodwill arises. So first one is the difference in the profit sharing ratio among the existing partners. Second one is admission of a new partner. Third one is retirement of a partner. Fourth one is death of a partner. Fifth one is dissolution of an enterprise involving the sale of the business as a trading concern. Next one is consolidation of partnership firms. Now, next one is methods of valuation of goodwill. So it is very difficult to access the value of goodwill as it is an intangible asset. In case of sale of business, its value depends on the mutual agreement between the seller and the purchaser of the business. There are many methods of valuing goodwill, but some of the important methods are as follows, like average profit method, weighted average profit method, super profit method, capitalization method, annuity method, purchase method. So first of all we will discuss about the average profit method. So first of all we need to discuss about the average profit method. It is the method which is very simple and widely used method for the calculation of goodwill. So under this method, the past profits of the number of years are taken into consideration. The average of the past profit is multiplied by the number of years of purchase for the purpose of the valuation of goodwill. This method is just a simple one step method, and in this we use the formula goodwill is equal to average profit multiplied by number of years of purchase. So if we discuss about the illustration, calculate the value of goodwill as on 1st 2021 on the basis of 3-year purchase of average profit of last 6 years. So profit and losses of the years were 2015 30,000, 16 40,000, 17 92,000, 18 55,000, 19 70,000, 20 90,000. So the total profit we add and we deduct the loss which is occurred in a particular year. So in the case of average profit, first of all, we take the total profit and we divide it from the number of years. And we have here total profit of rupees 2,97,000, and we divide this from the number of years, that will be 6. So our average profit is 49,500. So in the case of goodwill, average profit multiplied by number of years of purchase, 49,500 multiplied by 3 is equal to 1,48,500. So second one is weighted average profit method. So in the case of weighted average profit method, we need to calculate simple average first of all. It is like this, and under this method, each year adjusted profits we need to calculate in the step 2 above are multiplied with the respective number of weights in order to calculate the total profit. So total of product is then divided by the total of weights to calculate the weighted average profit. So thereafter, the weighted average profit are multiplied by the number of years of purchase. So this method is generally used when the profit show the continuous increasing trend over the years. So weighted average profit is equal to total of product of profits divided by total of weights. Then how we can calculate the goodwill? Weighted average profit multiplied by number of year purchase. So in the illustration 11.2, we have different number of years and their profit, and they give us weighted average profits using weights 1, 2, 3, 4, 5. So like this table, we can calculate different number of years profit which we already have. Then we multiplied profit into weights given in a question, and the total weights is 15, and the total amount multiplied by weights will be 6,90,000. So the weighted average profit is equal to total product divided by total weights. So is equal to 6,90,000 divided by 15 is equal to 46,000. So when we are calculating goodwill, that will be is equal to weighted average profit multiplied by number of year of purchase. So the goodwill is equal to 46,000 multiplied by 3 is equal to 1,38,000. Next illustration is also given to us. We need to calculate and we need to adjust like this. So if we just discuss about the steps which are involved in calculating this. So first of all, calculation of total profit. Then second one is calculation of average profit. Why in the case of loss, you will see that the figure is in brackets and the positive figures is without bracket. So when we need to deduct, or that will be if we are deducting something, or if the figure or the amount is in negative, then we need to show it in a bracket. So first of all, we calculate the total profit. Then in the step 2, we calculate the average profit. So the formula which we already discussed, total profit divided by number of years, we will get the average profit. In the step 3, we have calculation of goodwill, and the formula for this will be average profit multiplied by number of years of purchase. So the goodwill is equal to 1,18,500 multiplied by 3. And like this, we can calculate the year profit weights and the amount. And in the end, we have the weighted average profit and the goodwill. अब ये मत कहना चाय वाले So like this, we can calculate the weighted average profit. Here we have one more example in which we have additional informations like the goodwill you need to value 2.5 year of purchase of the average profit of last 4 years and the basis of the weighted average profit method by using the weights 1, 2, 3, 4 respectively, and they give us profit for the last 4 years. Then we have a profit of 2019 includes profit from lottery. Then we have profit of 2020 which include 16,000 of income from government securities. Then the existing tenancy contract has expired and X Limited will have to pay rupees 6,000 per month instead of rupees 4,000 per month. So first of all, we need to calculate the total profit for the 2000 year 18, 19, 20, 21. So the profit during the year we have 1,80,000, 1 lakh, 1,40,000, 1,60,000. From this, in the year 2019, we have a profit for lottery of rupees 10,000. So we need to deduct it from 2019. And then we have a profit in 2020 of rupees 16,000 of income from government securities. So we deduct that also from the profit of 2020. Then there is a additional rent of rupees uh, 2,000 for the 12 months. So that 24,000 will be deducted from all the years of rupees 24,000. And in the end, we have adjusted profits for 2018, 1 lakh 56,000. In the year 2019, 66,000. 2020, 1 lakh. 2021, 1 lakh 36,000. So the year which we have profits which we are calculated, then we multiplied it from the weights, and the weights are given in the question 1, 2, 3, 4, and the total of 1, 2, 3, 4 is equal to 10, and the number of years which we have is 4. So after that, the multiplication, we get the amount total of 11,000, sorry, 11 lakh 32,000. So in the next step, we need to calculate the average profit. That will be total profit divided by number of years. So 4 lakh 58,000 divided by 4, that will be is equal to 1 lakh 14,500. Then we need to calculate the goodwill. Then average profit multiplied by number of year of purchase. So we have a goodwill of 1 lakh 14,500 multiplied by 2.5. So we have the value of goodwill of 2 lakh 86,250. So in the case of weighted average profit method, we will divide 11,000, sorry, 11 lakh 32,000 from 10. So we have 1 lakh 13,200. So we multiply this amount from 2.5 and we have the goodwill 2 lakh 83,000. So if you check the valuation of goodwill from the average profit method, we have 2,86,250. And in the case of average weighted average profit method, we have it 2,83,000. Like this, we have a different example. In this example, there is a depreciation, and we will deduct the depreciation from the year which is given in the diminishing balance method, and that will be for rupees 40,000. So 40,000 from July 1, 2020. So we deducted accordingly. We also deduct the managerial remuneration from the profits of rupees 15,000 from each year. So like this, you can calculate the average weighted average profits. Then calculation of goodwill we will do according to this formula. Then we have a super profit method. So in this method, the average and actual profit of the business are compared with the normal profit which would have earned with the same capital in the same type of business If the average profit of the company exceeds the normal profit, the difference is known as super profit. So under this method, value of goodwill is calculated on the basis of super profit. Here we have some steps to calculate the super profit method. So in the case of super profit method, our first step is to calculate the capital employed by the following formula. That first of all, we need to add the fixed asset and working capital, or we need to add the capital reserve or accumulated profit, and we deduct the fictitious asset. In the step 2, we need to calculate the current year profit after tax, that the current year profit after tax is equal to current year profit. Then we deduct abnormal gain, then we add abnormal loss, deduct normal loss and add normal gain, and from the whole we deduct the tax. Our third step is to calculate the average capital employed. In the case of average capital employed is equal to capital employed, we deduct half of current year profit after tax. Then in the step 4, we will calculate the normal profit by the following formula. Normal profit is equal to average capital employed, then we multiply normal rate of return. Normal rate is always in percentage, so we divide it from 100. Step 5, we need to calculate the average profit after tax as per the average profit method. In the step 6, super profit is equal to average profit after tax minus normal profit. In the step 7, we have goodwill is equal to super profit multiplied by number of years of purchase. Calculation of capital employed. In the case of capital employed, it helps in calculating the normal profit of the business. So the following points are need to be considered while calculating the capital employed. Both current and fixed assets should be included in the capital employed. These assets should be valued at the current market price, and we have following assets should not be included, like fictitious assets, discount on issue of shares, debentures, preliminary expenses, etc. And outside investment should not be included in the asset. Goodwill appearing in the balance sheet should also not be included. Our second point is, from the total assets, the outside liability should be deducted. So the outside liability will include debentures, creditors, provision for tax, outstanding expense, bill payable, loans, etc. So if we need to calculate the net capital employed, so it will be fixed asset, added current asset, then we deduct the outside liability. Like this, we will have the balance sheet as on 31st March 2021. Then we need to calculate the value of goodwill on the basis of 2-year purchase of average profit on the basis of following information. First one is reasonable return on average capital employed invested in the class of business done by the company is 12%, and the tax rate they given us is 50%, and the profit of the company before tax are 2,20,000. So first step to calculate is to calculate the capital employed. We already discussed the formula, all the fixed asset, added current asset, and deduct outside liabilities. So in this question, we have land and building, plant and machinery, stock, debtors, cash, and from this we deduct creditors, provision for tax, and in the end we get capital employed. In the step 2, calculation of current year profits after tax, we have current year profit, then we deduct tax at the rate of 50%. In the end, we get the current year profit after tax. Then in the step 3, calculation of average capital employed is equal to capital employed, deduct half of current year's profit and tax. Then for this average capital employed, we have 7,12,000. Then we deduct half of 1,10,000. We have 6,57,000. In the step 4, we need to calculate the normal profit. Normal profit is equal to average capital employed multiplied by normal rate of return, that will given in the question is 12%. So 6,57,000 multiplied by 12% is equal to 78,840. In the step 5, we need to calculate the average actual profit after tax. So in the case of current year profits, we have 2,20,000. Then we deduct tax 50%, and the actual profit after tax will be 1,10,000. In the step 5, we will calculate the super profit. That will be average divided by actual profit after tax minus normal profit. So average actual profit after tax will be 1,10,000. Then we deduct 78,840 from it. Then we get 31,160. In the step 7, we have calculation of goodwill. So that will be the super profit multiplied by number of year of purchase. So 31,160 multiplied by 2 is equal to 62,320. So our value of goodwill is 62,320. In the same way, we have this illustration also, which you need to practice at your home. In the same way, these are the steps. First one is to calculate capital employed. Second, calculation of current year profit after tax. Third, average capital employed. Fourth, normal profit. Fifth, average actual profit after tax. Sixth, super profit you need to calculate. Seventh, calculation of goodwill. Our next method is capitalization method. Under this method, we need to calculate goodwill in two ways. First one is capitalization of super profit method, and second one is capitalization of average profit method. So first one is capitalization of super profit method. In this, step 1 is calculate super profit according to the super profit method. Step 2 is goodwill is equal to super profit method multiplied by 100 and divided by actually normal rate of return. You can also write this formula: super profit method divided by normal rate of return. Next, we need to capitalize the average profit method. In the average profit method also we have steps. First one is to calculate average profit after tax as per average profit method. Second one is calculate capitalized value of average profit. How we can calculate the average profit after tax? We divide it from the normal rate. Third step is calculate average capital employed as calculated in super profit method. Fourth one is goodwill is equal to capitalized value of average profit minus average capital employed. They give us note also: the use of average or actual capital employed will depend on the rate of return which is mentioned in the question. If rate is on actual capital employed, then actual capital employed will be used for the purpose, otherwise average capital employed. So we have an illustration for this, in which basically capitalization of actual average profit, capitalization of super profit, in which we have actual average profit, normal rate of return, actual capital employed. So in the solution, we have first of all the calculation of goodwill by capitalization of actual average profit method. So in this case, first of all, we have formula of average profit divided by normal rate of return. So we divide 60,000 by 10%, we have 6 lakh. Then we have second step, calculation of goodwill. So capitalized value of average profit, then we deduct the actual capital employed, 6 lakh minus 4 lakh 50,000, we get 1 lakh 50,000. Our second step is calculation of goodwill by capitalization of super profit method. In the step 1, calculation of normal profit. So normal profit is equal to actual capital employed multiplied by normal rate of return. So 4,50,000 multiplied by 10%, we get 45,000. In the step 2, we have calculation of super profit. So super profit is equal to actual average profit minus normal profit. So 60,000 minus 45,000 is equal to 15,000. Step 3 is to calculate the goodwill. Super profit multiplied by 100 divided by normal rate. So 15,000 divided by 10% is equal to 1,50,000. Illustration 11.9 we have, and we have different added points also, but the steps which you need to follow is same. First of all, you will calculate the actual average profit, then you need to calculate capitalized value of average profit, then you need to calculation of goodwill. In this way, you are having a different steps which you need to follow. Next one is annuity method. The reason for using the super profit method is that the amount paid for the goodwill in lump sum will be recovered in the coming years. For example, 60,000 goodwill is paid today, but this amount purchaser will get in the shape of super profit as rupees 20,000 in the next year, another 20,000 in the second year, and another 20,000 in the third year. So the purchaser will lose the amount of interest over rupees 60,000. So in the case of annuity method, the loss of interest is compensated. Then we have one is purchase method. So the profit of the company during the last 4 years were 32,000, 56,000, 40,000, 64,000. So the capital employed is 4 lakh, and the return in similar business is 10% on the capital employed. So you need to calculate goodwill by annuity method based on super profit. So the present value of rupees 0.282012 annuity for 4 years at 5% return of rupees 1. So like this, you need to calculate first of all normal profit. We have the formula is actual capital employed multiplied by normal rate. Then we second step is to calculate the average actual profit after tax. So we have the formula of total profit divided by number of years. Then we calculate the super profit, average actual profit after tax minus normal profit. Then we have calculation of goodwill. Then annuity is 0.282012, present value is equal to 1. So we 1 is divided by 0.28201 2 and multiplied by 8,000. So it will be equal to 28,367.58. So the goodwill will be 28,367.58. In the same way, we can calculate the goodwill in this question also. We have with balance sheet, we have a question also. So basically, this is your unit 11 of block 3. These questions you need to discuss or you need to practice at your home. So today we discuss about two units of block 3, that will be unit 10 and unit 11. In the one, we discuss about the subsidiary companies and the wholly owned subsidiary company and partly owned subsidiary company, and how we journalize the entries for it, and how we prepare the consolidated financial statements for it. Next one is valuation of goodwill. In the valuation of goodwill, we have different uh, steps which we need to follow and which we are fulfilling totally. So that's all for today. Practice these questions at your home. And the one unit is left in block 3, that will be unit 12, which we will discuss in our next lecture. Thank you so much.